All right, we're recording. Who's the group leader?
Good question. I don't think we ever assigned one.
Yeah, I don't know if we did or not.
Whoops. Let's go.
I can take this week, I guess.
I think there's only 4 questions, really.
Yeah, I mean, there's
Yeah.
not a ton in the thing here. Let me get it back up. Hold on.
While you're doing that, I'll just do a summary of as far as what I pulled from it. So Greg Gianforte, founder and owner of and CEO of RightNow Technologies, has built the software company from scratch and a $5,000 investment into a business generating $35 million in annual revenues. Company provides business software to respond to customers' email and has made some strategic changes to that direction over the last 6 years, is it? Since inception, the company has gone through 2 rounds of venture capital, strategy shifts, expansion, a failed IPO. Through it all, Greg has managed to retain control on a majority 60% stake. Now it has been 6 years from inception and the company is still growing. Currently, Greg has an offer for the company to be acquired by a major software company and competitor who has lost some market share to RightNow. Greg has to make an evaluation on the best exit strategy for himself, employees, company, and investors. The decision to be made is accept an attractive acquisition offer from a large competitor, or plan for an IPO in a year, or postpone exiting and continue to grow the company through organic growth. So that's it in a nutshell.
Very good. Very good. Okay, so yeah, just four quick questions to discuss tonight, I guess. The first one is, what value would you place on RightNow Technologies?
That's a good question.
89 million.
89 million, huh?
Okay, back it up. Give us your rationale.
Yep.
All right, so here's, I don't know if this is the easy one or not, but this one was, here's what I did to get to that number. I'll share my screen real quick.
Oh, I thought you were just saying a random number.
Oh,
Okay.
no.
All right.
I'll make this a little bit bigger so you guys can see it. Okay. So I guess I could round it up to 100 million. So the 12-month trailing was $35 million, or I think this is their 2003 revenue.
Yeah.
Okay. In the text or in the case, it kind of alluded that the larger competitor company might go off their revenue run rate of 2004, which was heading towards the 50 million mark. And I went through, I think it's Exhibit 3 in the case. I don't know if I can pull that up real quick or not. Anyway, there was an average of, let me pull it up so I'm not making things up here. It's sideways here on the screen, and I'm probably just pulling a number that I probably shouldn't. I use this 1.778 number here, estimated beta. I don't know if that's multiple or not, but I use that as my multiple. So if I take 50 million times a multiple of 1.78, the offer is around 89 million. It's an all-stock deal, multiple of many times sales. That was from the text. Anyway, so that's my rationale.
Very good. Anybody else?
Okay, I'll throw my spreadsheet up here. Let me pull it up here. Actually, I got to open it. I figured it a lot higher because all right, let me get it up.
Was there something in the case about 9 digits or 10 digits?
That they were talking about his would be like I think 7, 8, and 9 digits
Oh,
as
okay.
far as wealth creation.
Uh-huh.
Okay, can you guys see my screen there?
Yep.
Here's what I started with. So I just gave him a random 10 million shares to start off with as the founder. And then they did a Series A round with the first venture capital company. And they came to, so December of 99, they had a valuation of 100 million. And so that would, if they invested 16.4 million, then to get that valuation, they would have had to do a $7.08 share price, which would have given the venture capitalists 2.3 million shares, 16%. I threw in just kind of from our previous case that there is going to be an option pool, that's something venture capitalists pretty much require. So I threw in 13% because typically venture capitalists want 10 to 20% in an option pool. And he did bring on more executives, and I'm sure he probably offered them some stock options or something. So anyway, that diluted him down to 71%. And then for Series B, they came in with 16 million and a valuation of 129 million, which would have I would have had to play with this for hours to get it down to exactly 60%. But anyway, so this is pretty close. He was diluted down to 62%, the option pool 11%, and the first venture capital down to 14%, the second one at 12%, with the share price of $8 a share, giving them a valuation of 129 million. One of the hints that I picked up in the offer was that typically venture capital companies want a 2 to 3 times multiple of their investment, and that the offer would satisfy that requirement. So the other thing that I took was that the offer was, I can't remember what the wording is, but it was in line with the valuation of a market-leading company. So that's where I went down to, let me find it here. I think it's Exhibit 3. Let me rotate it on my other computer here. Yeah, so that's where I went to the market-leading company like Siebel and Epiphany. Both of those had market value to revenue of somewhere between 5.2 and 5.9. So that was kind of the clue that I got, was that this was a very fair and attractive offer, and it offered a value comparable to the market leaders in the industry or the market. So what I did is, you can see here, I pegged it at 5.2, the low end of that, 5.2 times, and again, like you mentioned, they were using their projected revenues of 50 million. So 5.2 times 50 million comes out to 260 million. and a share price of $16.14. And then if you come up here and look at the return multiple for the venture capital companies, the first venture capital company that got in at a little lower valuation, they're going to get a 2.28 multiple on their investment, and the last venture capital to come in at 16 million is going to get a 2.02. So that's how I came up with 260 million. And again, Aaron, I think yours is a good valuation based
Okay.
on comparable companies.
Mm-hmm.
And that's why when I compared the two things, a traditional valuation versus a valuation based on what someone's willing to pay,
Sure.
that's why, hands down, I say do it, sell it,
Oh yeah.
get this valuation, because that means he's gonna walk away with 9 figures. So 9 figures has got to be at least 100 million.
Mm-hmm.
So that's why I figured that it's got to be somewhere in this range for valuation. So he walks away with 161 million, and the venture capitalists double their money from 16 million to 30 some million. So that's my
That sounds like a
scenario
win-win.
there.
That's some good rationale. I like it.
Yeah, thanks, Norman.
I like
Very,
it.
very good.
I'll go next, I guess. Mine was a lot simpler than that. So under the section offer and the options, it talks about how the acquirer was willing to pay a multiple of many times sales, which was appropriate for considerable market-leading software companies at the time. So I just went to Exhibit 4. I took the valuation of 50 million, or their revenue run rate at 50 million, and averaged the multiple on Exhibit 4 for each of the 11 companies that they show there, and came up with 2.44, and I multiplied that by the 50 million, and that's how I came up with my valuation. I came up with 122 million as my valuation.
Okay.
And what was your dollar amount again, Norman? So I put in at, I'll round it up to 100 million. Dean is at 122 million.
Yeah.
And Norman, yours was 200, 240?
260.
260 million, okay. Thanks.
How about you, Victor?
I don't have a clear answer for you
Okay.
guys.
Dean and Aaron,
Yeah.
I don't want to poke holes at yours. Do you think at that valuation the venture capital firms would go for it? What percentage would you give? Would you think that the venture capital firms were at if he's at 60%?
Sure. Yeah. If it was 100,000, he would have 60,000. Or if it was at 100 million, he would have 60 million, and they would have 40 million between the two of them to split.
And they've each put in
16.
16,
or so.
16.4. So we're like at 32 million invested, and they're gonna get a max return of 40 million.
Sure. Yeah. Not very attractive there.
Yeah, not very. That's a really good point, Norman. I appreciate that. If I'm doing my math right here, 4 times. Yeah, let's see. 20, 4, 40, and that is 6. So, wow. I don't know that I did that right, but if I did my math right, in order for them to walk away with a 10 times multiple at that level, which is what most venture capital firms want, he'd have to sell the company for $747 million.
Well, it didn't. I know on I think the last one they were talking about a 7 to 10 multiple of their investment.
Yeah.
But in this case, they mentioned a 2 to 3 multiple. So maybe
Okay.
it was just the time frame, because it's such a short time frame, say since the last investor.
That makes sense.
But yeah, so I don't know if that's maybe just different industries that look for different multiple returns on it. Let me see if I can find that part where it talks about the offer and.
Just thinking out loud, it seems like Saturday when we discussed the negotiation, it was over like a 4-year period, 3 or 4-year period that they wanted to achieve that 10 times or 7, 8, or 9, 10.
All my
multiple.
classes seem to be blurring together this semester, so I don't remember. But in one of my classes, I know they talked about usually like a 6 to 10 year period being kind of the time frame for their expected return, and that the goal was a 7 to 10 times. And I've heard that not only in this class, in our last case study, but in multiple case studies and in multiple articles I've read about venture capital firms in the last 2 semesters. So
Yeah, that sounds familiar to me. Let me see if I can find it here. Okay, here it is. It's on page 8 of the case study, offer and the options. Another benchmark was related to the venture capitalist in the deal. It would be difficult to get their consent on an acquisition without a step up of at least 2 to 3 times the last round's post-money valuation.
interesting.
Without such an increase in value, the venture capitalist might be tempted to gamble on an IPO. So that almost says that's a pretty big clue that the offer at 2 to 3 times is probably going to be a better return than an IPO. The acquirer knew this and was comfortable that they could meet or exceed the expected range. So I kind of think I might, at 260 million, I might be a little low.
Yeah.
Mm-hmm.
I'm thinking the same thing.
But even at that low valuation, like I said, I don't think there's any other number. The only thing that I haven't run out on this yet, I just ran out of time today, was if we project his growth, project his growth to see what the valuation would be if they do the third option, which is grow organically, and then do something later. Which I think that would be see, depending on how far out you go, if you go out far enough and have rosy enough projections, you can surpass 260 million in valuation
Easily.
But there's a significant amount of risk with that, and I don't know. It's kind of hard to read him, whether he wants. It seems like he understands that he's not going to be satisfied being retired again.
Yeah. But
So,
and he has a history of
those employees.
Yeah. He sold a company once, for 10 million or so.
Yeah, it was 10 million. And he could, technically he could, and it didn't really allude to this or anything. I'm just postulating here. He could sell, right? Take his money and start a new company. Maybe he's tired of RightNow Technologies. And he could still reach his goal of 2,000 employees for Montana.
Yeah, maybe if he like bought some fast food restaurants up there, he'd get to his 2,000 employees goal a lot faster.
Gloria, how about you? Do you have any insight?
Nothing. Sorry.
That's okay.
I'm trying to figure out whatever you said. Only I read in the option first in page 9. I don't know. He talking about the competition and said the competitor is 40 times have 40 times more revenue than the RightNow competition. I understand better.
Yeah, so that means they're like a 1.4, $1.5 billion company, whereas
Okay.
he's only a $35 million company right now. And I think that showed that in the exhibit 3, which I have to keep turning sideways. Yeah, their 2003 revenue was 1.33 billion, 337, and their 2004 revenue 1.4 billion. So yeah, they're like 40 times the size. So for him to get a multiple as far as equity value for that, it's going to either take them a long time with organic growth to get to that, or he needs to take the money and run.
Yeah. Okay, and this is not an option for this guy.
What's not an option?
This option, the continue to grow up and have more revenue.
No, it is.
Yeah.
Yeah, it's option 2B on page 11.
Oh, yeah. Okay.
So, interesting. The next question states, please provide a range of values rather than a single number. How did you come to this conclusion? I haven't come to any range of values, but I could throw a few more out there if we wanted to just kind of...
Well, if you go back to, let me flip my screen here so I can look at this. I think that Exhibit 3 is probably, in my eyes, that was the most valuable one. So the range of options, if you follow my rationale here, would be, I still haven't rotated. So the range of options, if you're looking at market value to revenue, it goes that Canna software 1.3 or 1.5 multiples. So that's the low end. So you could say a range, you could do 1.3 all the way up to the high in that group of companies was 6.1. So the range for multiples 1.5 to 6.1, or you could go with the average in that group, which would be 4.0 to 4.5, or you could, use the enterprise value divided by revenues, which goes anywhere from 0.9 to
5.4.
5.8 down there for SAP. So like I said, my thinking is if you take those hints and that they're they're going to give the investors at least a 2 to 3, with maybe exceeding their expectations, maybe higher than a 3 return. Like I said, I would then say that the range, maybe the easiest way to look at it is give that range rather than looking at the multiples for these companies. Just look at the dollar amount. So if you take 16 million times 2, that's 32 million. 16 million times 16 times 3. So they'd get somewhere between 32 and 48 million times the percentage ownership.
Did we, maybe I missed it, did it give us details in here about what the what the valuation was that each round of venture capital placed on the company? I saw it in your spreadsheet, Norman, but I don't remember seeing it in the article.
Yeah, it was. It was 100 million post money for Series A and 129 million for post money Series B.
Okay. That's right. I remember that now. Okay.
And that was just, it was just 1 year later, and they were a little disappointed that the valuation hadn't gone up in that year more than 29 million, because in that period from when they did at the first valuation, their revenues were 2 million. At the second valuation, their revenues were 11.3 million. So they had increased their revenues 5 times, but their valuation only went up like a multiple of 0.29.
Yeah.
So I think that valuation of 129 million was probably pretty low based on that. But if you look at multiples, 11.3 million in revenue times, let's say 5.2. That's still only 58 million, so I don't know. It's not. That's why I think that offer is so generous.
Yeah. Another thing I thought of, just if I'm reading this right, so another range, if we're adding to our range of values, right, under the offer section where we just read, where it talked about the fact that they wanted a step up of at least 2 to 3 times the last round's post-money valuation. So if 129 million was the post-money valuation after the last round, and I'm sure it says 2 to 3 times, but we all know that they want the 3 times multiple rather than the 2 times multiple. So if you take that, that gives you a valuation of 387 million, just in real simple math. And the company says that they're, able to, that they could meet or even exceed that expectation.
So that would give you a range of 258 million to 387 million.
Yeah.
Yeah, I guess I would defend mine just saying, well, let's go with the very low end, the conservative estimate.
I'm happy to alter mine. I don't need to defend it. Mine was pretty simple math. Upon scrutiny, I don't think it holds any weight. But
Yeah, I changed my multiple from that 1.78 to a 4.5, and that mine came in after that at 225 million. A little on the low end still, I think, but a little more in the same ballpark now, I think.
yeah. Okay, so next question is if Greg's investors seek a 30 to 50% internal rate of return, what exit value will they expect?
Is that built into your spreadsheet there, Norman?
No. Are they talking 30 to 50% of 16 million?
That's my guess, yeah. And they each contributed 16 million, right? So that's 32 million. 50% of that total exit value for just those investors, if my math is right, would be about 48 million. But
yeah, I'm not sure how else to look at that problem.
See, 30% of 16 million is 4.8 million. So that would be like a 20.8 million return.
yeah.
And then 16 times 50% would be 8 million. So that'd be a return of 24 million on their 16 invested.
And if you multiply that by the 2 rounds, right? Because each round was 16 mil.
Yeah, but I get the idea that the first round was the one venture capital, and the second round, the first round was the one venture capital with this other venture capital participating. Then the second round was pretty much that participating one kind of going in. So it's hard to tell who had what of the 16 million.
Yeah. And it doesn't specify that here either. It just says if Greg's investors seek a 30 to 50% IRR, what exit value will they expect? So if we're lumping them all together, look at the 32 million in total as opposed to just the 16 million each, I think.
It's been a while since I calculated IRR. I'm just wondering if there's something missing. Because I think that's going to be like a 30% annualized.
Somebody's microphone. Is this
Everybody muted their.
Say
It
something.
sounds like it's coming from Victor's or Norman's. I can't tell. Might be Norman's. Is it gone now?
No.
Weird.
I think it's glorious. Gloria, mute your microphone for a minute.
I don't know where is my microphone.
Up in the top, where it has a little picture, right next to the picture of the person.
Yes, mute.
No, it was mute. Put it back for a second.
There you go.
Okay, now it's gone. Weird.
Okay, so Gloria, when you want to talk, just unmute it and then talk, and when you're done, you can mute it again if you want. You can give us a thumbs. There you go. All right. So just for review, internal rate of review is the rate of return is the interest rate, also called the discount rate, that is required to bring the net present value to zero. That is the interest rate that would result in the present value of the capital investment or cash outflow being equal to the value of the total returns over time or cash inflow.
Who's in that spreadsheet class right now?
I took that one last semester.
I
already forgot all that.
I used to have those Excel files all saved.
If the IRR is positive,
Me too, but I don't remember.
then it meets or exceeds the discount rate or the minimum hurdle rate. Sometimes it's called. So if our hurdle rate was, I don't know, should we put it all the way up to 30%?
Well, they're saying 30 to 50%, right?
40. In between.
Mm-hmm. And then, Norman, do you remember if we need a series of, like, do we need multiple years, or is it just a future value?
I think you can, let me just do this here, equals IRR. You can just type in the values, and I would just say 16 million 0, comma 0. How many years was it? From December 2000 to December 2003. So we'll put 2 zeros in there. This is too many arguments. Maybe I need to do maybe I will just make a range here. 16.
I've got my spreadsheet I used on the final exam for that class open, and it's got a IRR table. We can maybe populate that together real quick, Norman, if you don't get that one.
Throw 16 million into the first initial investment box or whatever.
Okay, I'm sharing my screen now, so our okay, and then let's do how many years? So 1, 2,
3 years. And then zeros in those.
Didn't like that.
Try putting 16 in as a positive number.
Trying to think. Could we put in revenues from year 1 and 2 and 3?
Where it says, where it has the error, what does the equation look like for it?
Yeah, go to your number. Yeah, that so IRR is C3 times
Maybe cut that. Yeah. Just C2 or
There you go.
Or C.
I think it wants some return values. Like if we had, I don't remember what he had the first year, like 8 mil. I don't know, 8 million, and then 6 million, and then 20 million.
I've got the numbers.
And even let's see, this first one needs to be negative,
Negative.
and that gives us a 40.
Okay,
40%.
so that was 99. Okay, so do year one revenue 11.3.
Okay.
I don't have 2001, but 2002 was 26. So let's just say 18 million for year two.
And it's somewhere between that and probably 35 million.
26.9 was 2002.
So,
Go ahead and throw in year four,
okay.
which would be 2003 at 35 million.
Yeah, that's huge.
Wow.
But those are
that-
revenues, right? So do they count for what we were calculating them in? I mean, those, because typically those would be returns, right? Returns on the investment. You can't count revenues as return on investment
Yeah.
because that's not.
Minus expenses probably, or
Does it?
I think I saw it.
And it's not. You can't use just the net income because the investment amount is more than 16 million, right? To get
Yeah,
to
because
those.
you're talking. So put minus 32 and 32.4 in there just for fun. And when they're talking in internal rate of return, the numbers in year 1, 2, 3, and 4, it should be cash flow values. And I don't
not given.
know.
We don't have a cash flow statement. You could try net income, but the net income is a negative number every year, so that doesn't work so good.
That might not work.
Yeah, I'm looking for. I don't see any cash flow. They just have balance sheets.
I would say you could even use working capital, but that's negative every year except 99 and 2000. How do you calculate that?
Yeah, it doesn't seem like it's really.
And even if we got a percentage here of the IRR, it's asking for a value, right? A dollar amount.
Well, yeah, so the question is, if Greg's investors seek a 30 to 50% internal rate of return, what exit value will they expect?
Yeah, I'm just wondering if we could come up with that number without using this IRR formula.
That is a good question.
I mean,
Do this.
they're
Yeah.
a real company, right? Because we could look up their. I could look it up.
Oh, I did some extra research too that I probably shouldn't have.
Yeah, who
Might have persuaded my decision.
Okay, do this.
Don't admit that on a recorded line, Aaron.
Oh, sorry.
That was a joke, right?
plug in 16 million, and then for year one, no, for year one put 0, year two put 0, and year three, let's put what their cash out would be under my thing.
Oh, sure.
Okay, so for year three, put 37,351,000.
And then a 0, right?
Yeah. Okay. So
That's within the parameters, yeah?
So in year three, then instead of the 37, so that'd be 30%, right? So they would expect about a $37,351 payout to get around 30%.
Yep.
Okay.
If you went and put 48, just plug in 48 million there.
That bumps it over 40. Well, not over 50 though. So
Yeah, so go 52.
Uh-oh.
Hang on.
Now they're losing money.
Oh, there
you
we go. Pretty close.
That is a little too high.
54 point. No, it's kidding. That was good.
Right there.
Perfect. Oh, yep.
Okay, so 16 million, exit at 54 million equals IRR 50%. Okay, so let's get the bottom end of the range. Let's play with that till we get 30%.
What was it, like 5?
Ooh, close.
That's close.
35 and a half.
Yeah, I would. There you go.
That's
That's
good.
good.
35 too.
35 too.
Okay, so that equals
Alright.
30%.
Perfect.
I knew we could figure it out. Put all these heads together.
How many business students at BYUI does it take to figure out? All right. Okay. So then the last question is: provide your analysis of each of the options Greg is considering. Based on your analysis, what should Greg do? Consider Greg's goals as well as the goals of everyone else who is involved in this venture. I haven't done any thorough analysis yet, so
let's do this for our decision analysis, kind of to answer this question. Who thinks they can give good pros and cons for option 1? To take the acquisition and grow.
Option 1 went first. Hold on.
Option 1, let's see.
That's to accept the offer, right?
Yeah.
That is to accept the offer. I'll go that one.
Okay, go ahead.
All right. So, pro, they all get cashed out quick, right? That's pro number 1.
Not really, since it's a stock offer. If they all get, eaten up, and so now they all have a lot of stock in this other company. If they all cashed out, sold that stock would maybe tank.
Okay, that's true.
Okay. All right. So then
They could probably take
there's a con
some
there.
cash out.
Norman, do you have a pro to this that you're hiding from us?
I think this is what Norman wants, isn't it?
Oh yeah, this is definitely what I want. But I mean, it lists one of the pros in here that they would have plenty of resources to grow and expand and develop their product. And I think the company that's acquiring them is looking to get that from them.
Right.
So one of the pros for Greg is he still can be involved. One of the cons I would say would be they may move all the jobs out of Montana.
I wonder if he could make that contingent on the sale, right? Leave the operations in Montana. Let's bring in talent, not only financial resources, but they could bring resources to bear in helping him meet his goal of creating 2,000 jobs in Montana as well, right? So he could potentially have a win-win there.
This is 2004 time, though, right? Not 2014.
Right.
I'm not saying that it's impossible in 2004, but much more feasible and doable nowadays than it was then.
The other pros that he mentioned is achieving quick scale, securing widespread distribution, which would really exponentially help the growth of their product.
Without
because right now they have limited visibility, limited distribution, limited exposure, and by becoming part of this larger company, they would just be plugged into all of that. So I think they can grow their particular product within this organization much faster, which should increase the value of this bigger company, which then increases the value of the stock that they got for their company.
So they would be more vested to see it succeed after the acquisition date.
Definitely.
Yeah, I like that.
Okay, so any other cons to it? I'd say the risk of lower stock value in the future.
Yeah, I mean the other con is that they're giving up the potential of an IPO, right? I mean that's not. I guess that's not technically. I mean that's not a tangible con, right? Because there's no knowing whether or not they'll actually get the IPO. There's no IPO offer on the table, right? But that's the idea, is that if they take the acquisition, they're giving up all other options, and therefore they're giving up the chance to grow to an IPO. They're giving up and I think the IPO would be the next best option. But I agree with you, Norman, on this one. I think the acquisition is the way to go.
Okay, let's look at the IPO. What are the pros and cons of the IPO?
So that was my choice prior to our meeting, prior to the start of the meeting. Norman, you've got a way of swaying us all. The pros for me included just the buzz that would be generated from an IPO. I think the case said something about an IPO is a marketing, I don't know, didn't use the word stunt, but a marketing tool to create buzz and enter more markets because it's now a publicly traded company and things like that. So I think the IPO would be successful, and compound that with the extra visibility from the IPO, it would be even more successful. Sure, there are legal costs, and I think there was somebody had to maintain the SEC documents or something like that, or their guidelines, and that was like $1 million a year, which was kind of a big chunk for this company. Trying to think, I think there was a couple more pros listed in the option summary. Investment banks were salivating to get RightNow's business. I guess a con would be there in the next sentence. The market for tech IPOs was still depressed at this point in time. There were not many optimistic signs in the marketplace. And they're kind of waiting to see what happens with Salesforce.com. If their IPO is successful, they share a business model with them. Is the stock market going to approve that, and they're going to take off? Thus, RightNow can take off too. I don't know. I think it's a wait and see kind of thing. If the IPO takes off for Salesforce, then great. There's kind of a model to go after. But right now, there's kind of a lot to question. Anyway, that was my initial choice, was to go for the IPO.
And I don't think it's a bad choice. The question in my mind that comes up is would the IPO give them an equivalent kind of return, right?
Sure. And this is where my spreadsheet skills don't exist.
Yeah.
If what stock price they sell and what does it do and what kind of returns would they get, I don't know. I honestly don't know how to generate that kind of a spreadsheet at this point in time.
Yeah, and we really don't have any numbers for shares outstanding.
Yeah.
Sure.
So we really can't compare stock. The only thing you can do is extrapolate stock price to revenue and that type of thing with the comparable companies.
Mm-hmm.
So that would probably be, I'm going to make a note of that, because if I do want to throw out an IPO valuation, I think that's what I'll do to come up with that, would be take the stock price. What about, well, I'm thinking of that. What about that one company that's going to come out with an IPO? Do you think they should wait 7 or 8 months until that IPO comes out?
So if they wait 7 or 8 months, are they passing on the opportunity? I mean, is this company going to be willing to wait
I don't
7
think
or 8
so.
months for them to make the decision, right?
Right, and they would probably reserve the right to change the offer based on the IPO. Then, so if the IPO does really well, then they may want to back out of the acquisition offer and do an IPO. If the IPO doesn't do well, then the acquisition offer is probably going to get lowered. So it's one of those, the company that wants to acquire them probably wants to lock in this valuation now.
Yeah.
Because it makes sense to them. That's why I think they should go for it, because yeah, there's a possible upside risk, but there's a really good possibility that the IPO for that other company does well, but it's still not in the 5 to 6 multiple range that they could have gotten 7 months earlier.
Yeah.
No, I'll keep my mouth shut at this time because I did read some stuff that happened to this company. And I'll share it with you guys later.
Yeah, you can fill us in.
All right.
next Tuesday.
Hey, did I tell you guys that I talked to Jim Sharp?
No.
You did?
Yeah.
I read that.
How did that come about?
Jim Sharp? Thanks, Gloria. So he was the one that bought the metal extruding company. And I was just like, I can't imagine buying a company and not being able to talk to employees. And, I was kind of wondering about that other extruding company that was going out of business and they were getting some of their customers. So I was just kind of looking to see what happened with that company. And I came on, he has like a website or a web page because he's actually like an entrepreneur in residence at the Harvard Business School.
Cool.
And it had his Harvard Business School email. So I wrote up a little email saying, we studied your case study from 30 years ago or whatever. And, I just had some nagging questions. I was just kind of curious, if you don't mind, letting me know what your thought process was when you did that. So I typed it like 3 or 4 questions, sent it off to him. And he emailed me back the next day and like answered the questions. He said, no, it's pretty standard that you don't talk to employees or managers. And the particular owner that he was buying it from had tried to sell it before, and basically the employees found out and had kind of sabotaged the deal. So this seller was really, really skittish with that. And then the company that went out of business was doing a lot of heat sinks and some other metal stuff, and stuff that the company he bought really wasn't doing very much of, but they did pick up some customers, and then he really expanded the marketing that they did and turned around and sold it. I think he was into it for his 100,000 plus the investors, and like for $4 million, I think he sold it for like 35 million.
Whoa.
So yeah, it was just kind of interesting. And then he asked like what school. He said there's hundreds of business students that know more about that time in his life than his own family does. So that case study has legs of its own. So he was curious what school I was going to and what class and what professor and stuff. So kind of cool.
That's awesome, man.
Yeah, that is cool. For another class, you guys probably wouldn't know this guy, but I had kind of a similar experience. I'm taking 499A this semester as well, and we had to do a due diligence assignment if you're taking it in iLearn 3, and part of that due diligence assignment, one of them was to read an article called "The Key Factors of Success," and it's written by a guy named Bill Birnbaum. And I clicked on the link they had in iLearn 3 for his article, and it wasn't there. So then I Googled the company to see if they were even still in existence, and I found a phone number, so I decided to call him, and it happened to be this guy's personal number. And talked to him for a few minutes, and he's sent me a copy of his book that he just published.
Wow.
On business strategy. So it was kind of cool.
Cool, man.
All right, well, I got to get going here, so.
As you.
Oh.
Okay, I think we're done. Anyway, I think that was the last question. So, thanks, guys.
Cool. Thank you, guys.
See you guys.
Oh, hey, what do we want to do about next week?
Oh.
Hey, well, we're thinking through that. Well, I won't say anything in case you haven't written your analysis yet. I'll keep my mouth shut.
It looks like the next one we've got Noodles and Company, and also Progresso Financiero.
I'll do the Noodles and Company.
Okay, I can do the Progresso one.
All right.
Awesome.
Norman, are you gonna set up the link for us?
Yep.
Okay. Very good.